Greetings, it is time for our monthly inflation update. And for this month's update, we, as usual, go to my familiar three-measurement matrix, where I try to take a multidimensional approach to measuring inflation, thereby diffusing all the claims that a certain index is rigged or a certain measurement is not comprehensive enough or holistic enough. And I've chosen a number that I believe is the best trade-off between avoiding deflation while maximizing technological progress, because technology feeds on inflation. Inflation is in fact a fuel for technology, but we don't want inflation to be higher than 3% because that would be negative for the poorest people in society. Now, if you're of a philosophy that we want technological progress and it's okay if the poorest people starve to death, then yeah, you could advocate for an inflation rate higher than 3%, but I believe that is not a pro-human approach, so we take the happy medium of 3% because it's equally important to avoid deflation. And I take three measurements: the 10-year compound annual growth rate of the US CPI, which is not rigged, even though the people who like to pretend inflation is much higher than it is so that they can feel like victims like to say that it is rigged. It is not rigged because the most important of these three measurements, the Goldman Sachs Commodity Index, is comprised of freely traded commodities, and it takes the world price. The US CPI is still only a US index. This takes the world price. Therefore, this is the best metric of all and the most comprehensive metric of all. And then the third one is the 10-year US Treasury Yield, which is not a measurement of past inflation as much as it is an estimate of future inflation, because it governs things like car loan payment rates and mortgage payment rates and so forth. So 3%, 3%, 3%. I need all three of these to be above 3% before I say that inflation is structurally a problem. One of these three being above 3% while the other two are below 3% does not comprise a situation that has high inflation at a structural level. And remember, there's tremendous pressure to pretend that inflation is higher than it is because it has become socially prestigious to pretend that inflation is high. So let's go to the Goldman Sachs Commodity Index first because it's the most important measurement. Goldman Sachs Commodity Index 10-year compound annual growth rate is minus 1.24%. Minus 1.24%. It is in deflation and has been in structural deflation for 10 years. This is an index that comprises of oil, natural gas, gold, silver, and a whole bunch of other commodities. It is very comprehensive. These commodities are freely traded and they are priced worldwide. Therefore, there's no chance that this index is rigged or manipulated in any way, and it indicates deflation. The other reason that commodity prices are the best metric of inflation is because commodity prices being low versus high is the one indisputable measurement of where lower is better, because there's a very minimal labor component in commodity prices, whereas service price inflation, which is not part of the GSCI, does count, and that's why we look at the CPI, which we're going to see in a minute. But it's ambiguous about what is good or bad because a service provider charging more means the customer pays more, such as for a haircut or something, but the service provider is simultaneously making more, so their wages rose. So in service price inflation, it is very hard to separate rising wages from rising service prices. Therefore, commodity price inflation is the purest measurement, and commodity prices affect the price of everything. Now we go to the second measurement, which is the 10-year US Treasury Yield. 10-year US Treasury Yield, 3.855%. So this is above 3%. And it's been above 3% for a while, but it has trouble breaking above 4%. It is hovering in this zone. This is putting a lot of pressure on the US housing market because this makes mortgage rates higher. But for a long time, this was well below 3% as well. And if you go back to the 1970s and 80s, it was much, much higher than this. So 3.855 is the number, very low by historical standards, but above my 3% threshold. So far, this is the only one that is above the 3% threshold. And now we go to the final one, the US CPI. This is the US CPI from the BLS.gov website, and all of the websites referenced in this video will be in the description box below, as usual. And we take this CPI absolute value. You can see this is the chart of the CPI. This is the most recent reading, 303, and you have to divide that by the reading exactly 10 years prior, which is this one, 232. So divide this number by this number and take the 1/10 root of that to get the annualized number. I will show you a table after this that describes exactly what that number is, but that is how you calculate the annualized inflation rate over a 10-year basis. And as we go down the list to different time windows, you'll see how that entire flurry of inflation was not only a non-event, but it's already in the past. 1 month percentage change. You can see that there was this blip for a very short while, and now it's moderated back down to this low status quo of structurally low inflation. 2 month percentage change, 3 month percentage change, 6 month percentage change, and 1 year percentage change. Some people say only the 1 year percentage change matters, but they say that when it's high. When it's low, they don't count for that. This inflation event was very brief and a complete non-event because it's falling as fast as it rose, and one should no more fixate on this than they should fixate on when it was low, and that's why the 10-year average is the only number that gives you an accurate, academically rigorous number. Everything else is noise, and this table takes in all of that data we saw from the bls.gov website. The shorter windows of time are more volatile, and therefore this number changes around a lot, but at an annualized level, this is what the 1 month, 2 month, 3 month readings come out to if you want to take a uniform annual time frame. The 1 year reading is 4.1%. Everyone was screaming for the short while when it was above 8%, which was for all of 3 months. That was more than a year ago. The last 1 year has had 4.1% inflation, and it's falling very quickly. It will soon fall to these types of numbers because this is the structural status quo. And then the 2 year, 3 year, 5 year measurements take in that bigger bulge that we saw before, but also tell you more about the structural inflation rates and the effect of COVID relative to pre-COVID. And the most important measurement is the 10-year window, which is still 2.7%. There has been 30.6% CPI inflation over the last 10 years, which comes to 2.7% a year. I'm surprised how few people understand this basic arithmetic. And the 1 year inflation rate was 4.1%, higher than this 2.7% trend, but it will converge back down to this as we are seeing, because these shorter time windows also have already low numbers. So we go back to my matrix. So we saw the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury Yield. As of today, June 17, 2023, what are the numbers? As we saw, the US CPI is at 2.7%, which is still below 3%. The most important measurement of all, the Goldman Sachs Commodity Index, is still in deflation, minus 1.24%. I believe the technonomic medium of the world, the atom, has in fact crushed the commodity complex, and we can never have commodity price inflation again, no matter how much money is printed. The economy has evolved to a level of sophistication where commodity prices can no longer ever be in inflation. And the 10-year US Treasury yield is the only one that's above 3%. It's at 3.855%. So we'll see what happens over here, but only one of these three is above 3%. I require all of these three to be above 3% before I say that inflation is high, and before we can say that money printing has been excessive. We have still never gotten to the point where money printing has been excessive at any time since quantitative easing began in 2009. So this was the monthly inflation update, and I hope you found this informative. Tune out all the garbage media content about inflation, which has caused some people to outright lose their minds and see inflation everywhere. Don't listen to them, because those are people who cannot parse data in an unemotional way and see what the facts really are. But if you're watching this channel, you're doing better than most on that front. Thanks for watching.